Welcome to today's class. We'll be doing the basics of ratio analysis today, which is liquidity ratios. We will be covering three ratios in today's class. They are current ratio, quick ratio or asset test ratio, and cash flow ratio. These ratios are studied to understand whether the company has the financial ability to repay its short-term liabilities. Let's get the class started with liquidity ratios. So what is liquidity? We need to understand that first before we study the ratios. So liquidity reflects the ability of a firm to meet its short-term obligations using its assets that are most readily converted into cash. 3 points here. One, it's the ability of the firm to meet its short-term obligations, and it is using the assets which can be converted into cash readily. So let's understand what do you mean by short-term obligations. It usually means 90 days or less are referred to as short-term obligations. So anything or any payable which needs to be paid within 90 days or in less than 90 days are considered to be short-term obligations. Assets convertible into cash within a short time period are called liquid assets. They are identified in the in the financial statement as current assets. Why do we say them as current assets? Because they can be converted into cash within the current period itself, or as we mentioned, within 90 days short term, right? So a company needs short-term assets to finance its short-term obligations for daily operations. So what do you mean by that? It means that to run your everyday business, you need assets like inventory, accounts receivable, cash, which you use to pay your short-term obligations. What type of obligations? Example are your accounts payables, your utility bills, your regular, expenses. All of these are short-term obligations for daily operations. A company should maintain a level of a short-term asset sufficient to pay its current obligations. Yeah. So we were saying that a company should maintain a level of short-term assets sufficient to pay its current obligations. So what this means is that the company should have enough money, okay, in the form of current assets, which I explained earlier, includes your accounts receivable, your inventory, your cash, and your marketable securities to pay its daily obligations, such as accounts payable as and when they become due, the wages, etc. However, a company does not want to have too much invested in short-term assets because these assets do not provide any return on investment. For example, if you block up your money in inventory, it becomes a dead investment until the inventory is sold. So you don't want to carry too much of inventory. You don't want to hold too much of finished goods wherein your money gets blocked up and you're not able to utilize that money efficiently and effectively. So what is the best way? The best way is to measure your current ratio, which is how much of current assets do you have to meet your current liabilities. So these are the ratios which help you understand, do you have sufficient money or assets, okay, to meet your current liabilities. So the three ratios we're going to study are current ratio, quick ratio or asset test ratio, and cash ratio. To start with, I'm going to give you what is included in current assets, quick assets, and cash ratio, right? So current assets, they include your inventory plus your accounts receivable plus your cash and marketable securities. Marketable securities are securities or bonds or investments which can be converted into cash at very short notice without too much of a loss when you convert it into cash. For example, if you have treasury bills or treasury bills issued by the US government, they can be converted into cash readily by selling them in the market, and the amount you will get when you convert a treasury bill into cash will almost be equivalent to the same value. Example, if you have $10,000 worth of treasury bill and you sell it in the market, you will get $10,000 worth of cash, or almost equivalent to $10,000 of cash. For example, you might get 9,995. So you're just getting $5 less than 10,000, almost equal to or equal to the same amount of your treasury bills you will get in when you convert it into cash. Those are called as marketable securities. So current assets include all of these. Now, what does quick assets include? Quick assets include everything given above except inventory. So what is it? It is accounts receivable plus cash plus marketable securities. Okay. Now, another way to put it is, I will write it here. Quick assets is equal to current assets minus inventory. Why do we deduct the inventory from the quick assets? Because the amount you will get on selling your inventory is not fixed. It is dependent on market. It is defined. You may get, the same cost as your production. You may get more or you may get less also. That is why you take out inventory to calculate your quick assets. And also the second point is that to convert your inventory into cash, it takes some time because it is not easy to sell all your goods readily for cash without incurring a loss. Okay? So that is why quick assets are current assets minus your inventory. What is cash ratio? Cash ratio is nothing but your cash in hand. Cash includes your bank balance. Please always remember, when we say cash, cash includes your hard cash and your bank balance. Okay. Plus marketable securities. Right. Which can be easily converted into cash readily. Cash and marketable securities. So cash, bank balance, and marketable securities. Wherever you be say cash, we always refer to it as cash and bank balances. Okay, bank balance is considered as good as having hard cash in hand. So cash ratio is cash plus marketable securities. Now, these are the assets. You compare them with your current liabilities. Okay. Now, current liabilities are your accounts payable and any expenses which are short term, which will be paid within 90 days or payable within 90 days. You compare these with your current liabilities. Now, when you take your current assets and divide by current liabilities, this gives you your current ratio. So what is this? So it tells you how much of current assets do you have to cover your current liabilities. For example, this is only an example. Let us say you have $20,000 worth of current assets. Okay, divide that by $10,000 of current liabilities. So this is current assets by current liabilities. This will give you a current ratio of 2. So, or you can say current assets to current liabilities ratio of 2:1. Generally, this is what is used. Current ratio of 2. Now, when it says you have a current ratio of 2, what does it mean? It means that you have current assets worth twice your current liabilities. That means you can pay your current liabilities 2 times over with your current assets. You have enough current assets to pay your current liabilities twice. Let us say you don't do any business for 6 months. Okay, but you have to pay your current liabilities. So you can use your current assets. You can sell off your inventory. You can collect your accounts receivable, use the cash that you have in your hand to pay off your current liabilities. So if you don't do any business for 6 months, it means that you can pay your current liabilities twice with the existing cash, inventory, and accounts receivable that you have. That is what it means. Okay. Next is quick ratio. So let us understand quick ratio as well. So quick ratio, like I have explained earlier, is your current assets minus inventory divided by current liabilities. Okay. In the above example, I have given you 20,000 as your current assets. Let us say you have inventory worth $2,000. So your quick ratio in this case is current assets 20,000 minus your inventory worth 2,000 divided by current liabilities of 10,000. So you have 18,000 divided by 10,000, which gives you a quick ratio of 1.8. Okay. So what does this ratio of 1.8 mean? It means that you have enough funds, okay, and accounts receivable to pay your liabilities 1.8 times. So if you were to stop your business today for 6 months, no sale happening, you're only using your accounts receivable money that you're collecting and the cash balance that you have to pay off your current liabilities. You can pay off your current liabilities 1.8 times. That means once you can pay off 10,000, the second time you will have 8,000 of the current liabilities to pay off, and you will be short by 2,000. So 1.8 times you can pay your current liabilities. That is what it means. Now the next one is cash ratio. What is cash ratio? I told you it is cash plus marketable securities by current liabilities. So using the same above example, let us assume out of 20,000 current assets, your cash and your marketable securities amount to $10,000 and you have current liabilities of 10,000. So it will be 10,000 divided by 10,000, which will give you a cash ratio of 1. So what again it means is that you have enough cash and marketable securities to pay your liabilities once without, if you're not doing any business, without touching your inventory or your accounts receivable, using only your cash, bank balance, and your marketable securities, you can pay your current liabilities once. This is what cash ratio means. The same thing is explained in terms of words. Okay. The most commonly used measure of short-term liquidity relates to current assets to the claims of short-term creditors. Working capital is expressed in dollars. So working capital is current assets minus current liabilities in dollar value. The current ratio is the same working capital expressed as a ratio, right? Current assets divided by current liabilities. Companies with aggressive financing policy will have lower current ratios. Conservative financing policies result in higher current ratios. What is considered normal is 2:1. So our current ratio of 2. When you say 2:1, we say current ratio of 2. So what this means is you have enough current assets to cover your current liabilities twice over. In other words, you have enough current assets to pay your current liabilities twice, even without getting into or doing any business. The quantity of receivables, or sorry, the quality of the receivables and the inventory matters. What does it mean? Now, when we calculate current assets, we are saying it includes accounts receivable, inventory, cash and cash equivalents, or marketable securities. Why does the quality of receivables and inventory matter here? If I have accounts receivable of, let us say, $15,000, but out of the $15,000, let's say 50% is bad debts. Okay? which means 7,500 is not collectible. So even though on the books I have current assets worth $20,000, out of which 15,000 is accounts receivable, the amount I can actually recover from the accounts receivable is only 7,500. So in reality, my current assets is reduced by 7,500 and it comes down to 12,500. The same is with inventory. If I have obsolete inventory, which I cannot sell in the market, then that inventory has no value. Or if I have defective goods that cannot be sold without being reworked to be made saleable, then that inventory is useless because nobody will buy that inventory from me and I cannot convert that inventory into cash. That is why the quality of the receivable and inventory also matters as a part of your current assets. Quick ratio. Quick ratio, like I explained to you, is current assets minus your inventory. Okay. A more conservative version of the current ratio, it measures the firm's ability to pay short-term debts using the most liquid assets. Inventory is not included. If a company uses inventory to pay its liabilities, then how will it generate future cash flow? That is why you are not including inventory. Always remember, in each of these, cash includes cash and cash equivalents. Both are included, and it includes your bank balance also. That is why specific over here, a note saying cash includes cash equivalents. Cash equivalents are your bank balance, okay, and your marketable securities. Your short-term securities are also converted, which can be easily converted into cash, also included in it. So cash includes cash equivalents. The quick ratio is your current assets minus your inventory. So whatever money you generate by selling off your inventory is used to run your everyday business, and your cash, marketable securities, and accounts receivable is used to pay off your current liabilities. That is called as quick ratio. The third ratio is cash ratio. Another derivation of the current ratio, but it is even more conservative than the quick ratio, is its cash ratio. It measures the ratio between cash, marketable securities, and current liabilities. So how much of cash and marketable securities do you have to pay off your current liabilities? That is your cash ratio. Now, in all the three ratios, you need to remember that wherever we say cash, it includes the cash equivalent, which is your bank balance as well. Okay. Now, what we can look at it, what we can understand from this is, you start with current ratio, okay, which is your current assets, and then you have your quick ratio, which is your current assets minus your inventory, and then you have your cash ratio, which is your current assets minus inventory minus accounts receivable. So you see, as it progresses, okay, you're only considering those assets which can be used or can be converted into cash, all are in the form of cash. Now, if you look at a US balance sheet, okay, the balance sheet always starts with the most current, or not current, it always starts with most liquid assets. If you look at the US balance sheet, it starts with the most liquid assets. So you will always find cash plus cash equivalent first. Okay. And then you will have current assets. And then you will have, non-current assets. And then investments and so on. So the logic behind is this, that a person who's studying or reading a US financial statement would like to first understand, does the company have enough money to pay its short-term liabilities first? Because if you cannot pay your short-term liabilities, that means you have a cash flow problem. There's a big issue with your cash flow. And if you have a cash flow problem, sooner or later, I would say sooner rather than later, there is a long or heavy chance of you or your business becoming insolvent. Okay? That is why you will see a US balance sheet starting with its most liquid assets. This is about, liquidity ratios. Now, there are problems based on liquidity ratios. We will do a couple of them to see how it works. So here's the problem, question number 18, which we will try and solve. Okay. So a condensed comparative balance sheet for a company appears below, and they give you cash as on 31st of December year 1 and 31st of December year 2. So 40,000, 30,000 cash, accounts receivable 120, 100, inventory 200, 300, property, plant and equipment 500, 550, accumulated depreciation 280, 340, total assets 580,000, 640,000, and then you have current liabilities 60,000, 100,000, long-term liabilities 390,000, 420,000, stockholders equity 130,000, 120,000, total liabilities in equity 580,000, 640,000. So the balance sheet tallies, you have assets worth 580, liabilities and equity worth 580, and 640 for the assets and 640 liabilities and equity. In looking at the equity ratios at both the balance sheet date, what happens to the current ratio and asset test ratio? Okay. So they're comparing year 1 current asset ratio with year 2 current asset ratio, and they're comparing year 1 asset test or quick ratio, also called as quick ratio, with year 2 asset test or quick ratio. So let's look at this, how it works out. So you have year 1 and you have year 2. Okay, let's look at the current assets for year 1. Year 1 is 40,000 cash. You have cash, okay, plus accounts receivable of 120,000 plus 200 inventory. Okay, and in year 2 you have 30,000 plus accounts receivable of 100,000 plus inventory of 300,000. Right? So this is the current assets for year 1 and year 2. And current liabilities for year 1 is, you have total assets, current liabilities 60,000 and 100,000. 60,000 and 100,000. It is given in the question. We don't have to calculate this. Now let us calculate current ratio for year 1. So 40 plus 120 is 160. 160 plus 200 is 360. So you have 360,000 divided by 60,000. So this is current ratios, current assets divided by current liabilities. Okay. And for year 2, we have 30,000 plus 100,000, 130 plus 300. So you have 430,000. 430,000 divided by 60,000. So how much do we get the current ratio as? 360 divided by 60, you get 6. And 430 divided by 60. Oh, no, sorry. This is 100,000, not 60,000. This is 100,000 for year 2. Is that correct? 60, yes. And 430 divided by 100, you get 4.3. Okay. And let's look at the quick ratio now. What happens to the quick ratio? Quick ratio is current assets minus inventory divided by current liabilities. So in this case, it is 360,000 minus your inventory of 200,000 divided by 60,000. And in this case, it is 430,000 minus inventory of 300,000 divided by 100,000. So you have 160,000 divided by 60,000, and you have 130,000 divided by 100,000. So how much do you get? 160 divided by 60. You get 2.66. And here you get 1.3. Okay. So compared to year 2, what has happened? Year 1 and year 2, if you compare, in year 2, it has reduced from 6, it has become to 2.66. Same is with quick ratios. From 4.3, it is 1.3. So in looking at liquidity ratios at both balance sheet dates, what happened to one? Current ratio. Current ratio decreased. What happened to quick ratio? Quick ratio also decreased. So the answer is option C, which is decreased. Current ratio decreased, quick or acid test ratio also decreased. That is the answer. This is how you will have to calculate your current assets and current liabilities, and then use those to calculate your current ratios, quick ratios, and cash ratio. In this example, even though they have not asked, let us calculate what is the cash ratio. Cash ratio in this case will be 40,000. That's only cash. There is no marketable securities. Okay, divided by your current liabilities, which is your 60,000, and in year 2 it is 30,000 divided by 100,000. So what do you get? You get 0.66 for this, and you get 0.3. So if you look at this, even your cash ratio has reduced compared to year 1. In year 2, your cash ratio is also reduced. It has come to 0.3. From 0.66, it has come down to 0.3. So these are the ratios that we study or we use to calculate whether the company has enough assets to meet its short-term obligations. Thank you.